that yields are likely to kind of continue to face upside risks. I mean, globally, because obviously Fed is doing what it is, or Fed is not doing, markets are doing it for the Fed. But the rest of the central banks are all headed higher, which means global rates are headed higher. See, when we talk probably 6 months down the line, it's more likely that rates will be higher than lower. That I think is more or less a given. In that kind of a context, therefore, when I talk about Indian equities, how would you therefore look at it from a valuation perspective?
No, so I think US yields going up is of course repricing valuations across the board, right? Because there's the riskless asset and so on and so forth. And
so
spreads
you're
and
basically, for the uninitiated, you're saying your world's risk-free asset is giving you 5.2, then any other asset has to give you way above that. I mean, something like an emerging equity has to give you more returns than that.
And you've seen that these yields have gone up by 20-25 basis points in a matter of just about 3-4 days. And so that's like a rate hike, effectively. It's a 25 basis points rate hike, effectively. And that's really what he's also said.
And rate hike through, I mean, right up to the 30-year.
It's transmitted right up to the long. So I think, so therefore, yes, of course, therefore there will be an upward pressure on bond yields. You've seen our yields elsewhere kind of go up, not commensurately, but it's just, it's crawling up in a way. But see, when it comes to equity markets and in you know, so far as our markets are concerned, and what happens to FPI flows, I am not very sure historically there is data to kind of suggest that FPI flows in India are linked so much to interest rates. Therefore, if you look at history and see periods in time, you will find that even when rates in India have moved up, you have seen FIIs come into India, provided our earnings growth has been good. So for us, finally, it's all coming down to whether earnings growth is coming through or not. That's the important question that begs an answer. And thankfully for us, early data seems to suggest that somewhere we are in the cusp of a good earnings upcycle. So that is a good thing. The second point I think that global investors have been worried about is the currency. Because you saw suddenly since October last, the currency actually coming off very sharply. That is unnerving. You can't have,
I think
too much of
11% kind of a depreciation in a year?
In a year we've seen 11.5 or thereabouts, So I think to gradually keep moving down is absolutely fine, because we are a current account deficit economy.
So 2 to 3% was the usual norm.
That is the 3.5 used to be the norm. 2, 3, whatever that number is. That's fine. I think everybody accepts it. And there is a very good rationale for that, and simply because of the current account deficit. But these large movements that happen, they tend to unnerve investors. I think this FCNR thing, we've just bought a band-aid for ourselves and secured this year, basically from being a BOP.
Sorry, but while you're on that,
BOP surplus.
The FCNR, is it intact? We had a lot of newspaper articles giving us. So I'm sorry to interject, but are we getting flows there?
The governor has said, right, that we are at 32 billion over there, and by various indications, so we did 26 in 2013, 26 billion. Now we are at 32 already.
We've crossed that.
Crossed 32, closer to 40 now.
And we still have.
And we still have a good. We are just entering August, so 2 more months to go. So just 1/3 of the period is over, and typically a lot of the flows tend to get bulked up, punched up towards the end of the period, so September. So I think people, in fact, in the last week, 10 days, if you see, people have bumped up their expectations of what we can pull in through this route. So I think that is, I think that money is coming. Whether it is 60 or 80, we don't know, but so long as it is in that ballpark number, I think the BOP for this year is kind of answered. So what it does is, to go back to that point, it brings a certain amount of stability in the currency. So gone are the days when people started saying that, oh my God, we are at 96.5, 100 is just a kissing distance away, and we're probably going to hit 110. I think that is now out of the picture. Yes, we'll probably hit 100, but not in a hurry. We'll probably take a little while. But we're kind of saying
that's
that
the normal depreciation is what
that's the
you're
normal
referring to.
depreciation path. And I think somewhere this FCNR is also helping the RBI very nicely unwind the short dollar position that they had. So I think it's helping in several fronts, and it is it has bought us some time. So therefore, with the stability of the currency and the earnings upcycle kind of taking shape,
and a little bit of the rotation that you referred to earlier.
and the
right?
whole AI related rotation that's happening, the anti-AI rotation, we seem to be in a zone where FIIs likely can come back.
I
And
think
we are
this
seeing
month,
signs
yeah,
of that.
this month
so
we've been a little
this month we've already seen. And somewhere I was seeing someone say this, that if India's underweight, I mean the whole world, the FPI base, if you see, is underweight India by the largest margin in probably a couple of decades. And apparently, if they were to even bring it back to the benchmark, we could pull in $100 billion.
That's a lot of money.
So that's a lot of money. But yeah. So I think even if it is not that much, I think what it does is, if the FPI flows were to start coming back into India, I think it will do a world of good from our own BOP position, and probably will give more confidence even for the FDI. I think that
which
picture
is the
is
bigger,
also
more structural.
and that picture also apparently is changing. I think it is turning. FY26 seemed like a difficult period, but it looks like on a rolling 12-year basis.
First 2 months of
the numbers are looking good apparently there as well.